Hello, Professor. My name is Rashi Yadav, and my student ID is 1040625. And with me are Mia, Punya, and Arvind. Today, we will be presenting our evaluation on Vietnam as a destination for foreign investment. Our presentation will cover Vietnam's economic, political, and market environment, along with key risks and our final investment recommendation. Vietnam is a fast-growing Southeast Asian economy with a population of approximately 102 million. Its capital is Hanoi, and major cities include Ho Chi Minh and Da Nang. The nominal GDP is USD 484.73 billion. The economy grew strongly in 2024 at 7.1%, driven by exports and foreign direct investment. Growth is projected to ease to 6.5% in 2025 due to global trade pressures, yet Vietnam still shows strong economic resilience. For 2026, while the government aims for 10% growth, international forecasts remain more measured at around 6 to 6.3%, driven by stable domestic demand and resilient export performance. Inflation remains stable at 3.4%. The currency is the Vietnamese dong, and the governance is improving under the Communist Party of Vietnam with a CPI score of 40 out of 100. Vietnam offers a large youthful consumer market and a stable political environment. Vietnam is a one-party socialist republic governed by the Communist Party, which gives the country a high level of political stability. The current leadership under the President To Lam and Prime Minister Pham Minh Chinh has been pushing strong pro-business reforms and encouraging more private sector participation. In terms of governance, Vietnam's corruption perception index is 40 out of 100 as of 2024, showing gradual improvements due to the ongoing anti-corruption campaign known as the Blazing Furnace. There are still some bureaucratic challenges, but overall transparency and regulatory efficiency have been improving. FDI continues to be one of Vietnam's biggest strengths, with the government focusing on attracting high quality investment in manufacturing, technology, and green industries. And finally, key policy priorities include expanding the digital economy, accelerating the green transition, and upgrading logistic infrastructure. Vietnam's external economic environment is stronger than ever. The country is deeply integrated into global trade through Asian and major agreements like CPTPP and the EVFTA, which have significantly expanded market access and lowered tariffs across key export sectors. FDI momentum is exceptional. Vietnam attracted over USD 38 billion in new commitments in 2024, and by the first 10 months of 2025, inflows reached USD 31.5 billion, a 15.6% year-on-year increase. Most of this capital is going into high-value sectors such as electronics, renewable energy, semiconductors, and advanced manufacturing. This surge is being driven by a major shift in global supply chains. Rising manufacturing costs and geopolitical tensions in China are accelerating the China Plus One strategy, pushing companies like Samsung, Apple, and Foxconn to expand production in Vietnam. As a result, Vietnam is becoming one of the most important manufacturing and export bases for the US and Europe, especially for electronics, machinery, textiles, and furniture. Sustainability is also a core pillar of Vietnam's economic strategy. Under the Green Growth Strategy 2025 to 2030, the government is offering strong incentives for clean energy, circular circular economy initiatives, and environmentally responsible manufacturing, making the country increasingly attractive to green investors. Infrastructure development is another major drive of competitiveness. Under the Vietnam 2030 Transport Master Plan, the government is upgrading expressways, expanding airport terminals in Hanoi and Ho Chi Minh City, and increasing seaport capacity to support rising export volumes. Overall, Vietnam is positioning itself as a fast growing, stable, and highly competitive hub for global investors, combining strong trade agreements, record FDI, world class manufacturing expansion, and a clear long term commitment to sustainability and infrastructure modernization.
Hello, myself Punya. My student ID is 9960053, and I will be talking about the country evaluation for foreign investment for Vietnam. I'll be covering the main aspects including economic environment and political and regulatory environment. Beginning with the economic environment, I'll be covering the GDP trends, sectoral strengths, inflation, interest rate, fiscal policy, and labor market conditions. When we look at Vietnam's GDP performance, the country has shown consistently strong growth, mainly driven by foreign investment and export led manufacturing. Back in 2014, the economy was growing at around 6% as it continued recovering from the global financial crisis. Growth stayed strong in 2016 at 6.21%, even with the global uncertainty. By 2018, Vietnam reached 7.08% growth, which was the highest point before the pandemic and reflected a strong manufacturing and trade boom. During the COVID 19 in 2020, Vietnam was one of the few countries that still maintained a positive growth of 2.87%. The rebound in 2022 was especially impressive, with GDP rising by 8.02%. However, the growth slowed to around 5.05% in 2023 because the global demand weakened. But by 2024, the growth again raised by 7.09%. Moving to sectoral strengths. In terms of structure, Vietnam has been shifting away from agriculture and moving strongly towards industry and services. By 2024, industry and construction accounts to about 37.6% of the economy, with manufacturing, especially electronics and smartphones, and machinery playing a major role. Services make up roughly 42.3%, supported by sectors like wholesale and retail, logistics, and transportation. Another major area is renewable energy. Vietnam has committed to a large energy transition supported by $15.5 billion Just Energy Transition Partnership. This supports the Net Zero 2050 target and the country's Power Development Plan 8, creating big opportunities for foreign investments in renewables. Moving on to inflation, interest rates, and fiscal policy. Over the past decade, inflation in Vietnam has been very stable, averaging around 2.8%, which is below the government's target range. The government has managed public debt effectively, reducing it from 52.7% of GDP in 2016 to the 3.5% projected for 2023. The central bank raised interest rates in the late 2022 to control the inflation, but as the condition eased, they cut the rates again to 2020. They cut the rates again in 2023 to support the economic recovery. Talking about the labor market conditions, Vietnam has the benefits of having a large, young, and affordable workforce. Unemployment has remained low, however, to 2.2 to 2.3%. The main challenge is that only about 27% of the workers have a formal degree or a professional certification, which means that the foreign companies have to invest in high skill training investment programs. Moving on to political and regulatory environment. First, I'll be discussing the political stability and transparency. Politically, Vietnam is considered very stable under the Communist Party's leadership, with policy changes following structured, predictable cycles. Since 2016, the government has been running a major anti corruption campaign, which has led to improvements in Corruption Perception Index. The score has increased from 31 in 2014 to 40 in 2024, and the country's ranking improved from 119 to 88. Foreign ownership rules. Vietnam generally allows full ownership in manufacturing. However, sectors like telecommunication, energy still have restrictions. The law on investment from 2020 introduced a clear negative list of prohibited and restricted business area. And in 2025, the government raised the foreign ownership limit in recurring commercial banks to 49%, showing a gradual opening of the financial sector. Talking about the legal protection and property rights in Vietnam, one of the most important aspects is land ownership. In Vietnam, all, all land is owned by the state, so both the domestic and foreign investors receive the land use right instead of ownership. And these rights typically last to only about 50 to 70 years. Disputes around land use compensations are common, but the Law on Investment 2020 does provide guarantee against nationalization and ensures that profit can still be repatriated. This graph shows the foreign investment in Vietnam over the past 10 years. Next, we will be moving on to ease of doing business in Vietnam. Although the government is improving administrative processes through a single window system, the e government initiatives, many foreign investors still face bureaucratic challenges, especially at the provincial level. The public private partnership law introduced in 2020 is intended to streamline infrastructure projects approvals, but implementation has still been really slow. Talking about the data localization and cybersecurity, Vietnam's cybersecurity law also affects foreign investors. Under the 2019 law on cybersecurity and later decrees, companies that handle Vietnamese user data may need to store the data within Vietnam and should have a physical office within the country. This adds compliance requirements for many foreign businesses, particularly those in tech and digital services. The further aspects will be discussed by my colleagues. Thank you.
Hello everyone, my name is Arvind Bose and my student ID is 9992728. I'll be discussing about the trade and investment policies of Vietnam, which makes it the ideal place for foreign investments. To begin, let me give a quick overview of why Vietnam is considered one of the most trade integrated economies in the world. Vietnam has an exceptionally open economic model. One of the most striking indicators is that its goods trade equals 185% of its GDP, a level usually seen in re-exports hubs like Singapore, not in large developing economies. This shows how deeply Vietnam is plugged into global production networks. A major driver of this openness is Vietnam's extensive network of trade agreements. The country is a member of CPTPP, the EU-Vietnam Free Trade Agreement, the ASEAN, and the RCEP, which is the world's largest trading bloc. In addition, Vietnam maintains bilateral free trade agreements with Japan, South Korea, and the United Kingdom, giving it preferential access to many of the world's largest consumer markets. These agreements have reshaped Vietnam's export structure. Today, electronics account for about 40% of total exports, driven by global giants like Samsung, Apple, Dell, HP, and others trying to expand their manufacturing footprint in the country. Another important trend is Vietnam's increasing role in post 2018 US China tariff shift. Roughly 50% of US imports that moved out of China during the tariff war have relocated to Vietnam, making it a major beneficiary of global supply chain diversification. As a result, nearly 30% of Vietnam's GDP now comes from exports to United States, making it the US Vietnam's most important single export market. And the momentum continues. From January to October 2025, Vietnam recorded about $391 billion in export value, with a trade surplus of $16.82 billion and year-on-year growth of 17.5%. Overall, this combination of trade openness, strategic agreements, and shifting global supply chains has positioned Vietnam as one of the world's fastest growing economic driven by export. Moving on to Vietnam's trade and investment policies, which play a major role in attracting global manufacturers and shaping the country's economic transformation. Vietnam offers some of the most attractive FDI incentives in Asia. Companies investing in priority sectors can access corporate tax holidays for 4 to 9 years followed by a preferential tax rate of just 10% compared to the standard 20. Beyond tax reduction, Vietnam also provides direct subsidies, often covering 15 to 20% of total investment, especially for technology transfer, R&D, renewable energy projects, and strategic infrastructure. A major structural advantage is the presence of 300 or so special economic zones and high-tech parks. These zones often offer streamlined regulations, modern facilities, and long-term land leases up to 50 to 70 years, making them highly attractive for foreign firms planning large-scale long-term manufacturing. Vietnam is also pushing its Made in Vietnam 4.0 initiative, which encourages investment in green energy, AI, semiconductors, and EV battery production. This signals a shift from labor intensive production to higher value, technology driven sectors. In terms of inflows, Vietnam attracts around 6% of GDP in FDI annually, which is extremely high for an economy of its size. In 2025, year to date, the country secured $31 billion in FDI, with manufacturing accounting for 62.5% of total inflows, showing continued confidence in Vietnam as a key production base. Looking at investor profile, Singapore leads with $3.7 billion, followed by China and Hong Kong at $1.48 billion. Major global players such as Apple, Dell, and Microsoft, Foxconn, and Pegatron have already established significant operations in Vietnam, reinforcing its role in global electronics and supply chain. Finally, one of Vietnam's biggest competitive advantage is its young and energetic workforce. With a median age of 26 and average labor cost of $300 to $350 per month, Vietnam remains both cost competitive and demographically favorable compared to China and Thailand. Moving on to Vietnam's infrastructure and logistics, which form the backbone of its export-driven economy. Vietnam's transport infrastructure has expanded rapidly over the last decade. Country's major port system is built around Haiphong in the north, Da Nang in the central region, and Ho Chi Minh City in the south. Within HCMC, the Sai Map Tai Wai Deepwater Port has become one of Southeast Asia's most important shipping hubs, capable of handling large long-haul vessels directly to Europe and the US. Beyond ports, Vietnam has been investing aggressively in expressways, airports, and railway upgrades, especially the north-south corridor that links Hanoi to the Ho Chi Minh City. These improvements have significantly strengthened domestic connectivity and reduced logistic bottlenecks for the manufacturers. In terms of performance, Vietnam ranks 43rd globally in the World Bank's 2024 Logistic Performance Index. This puts Vietnam ahead of several regional peers, but there are still clear limitations. The country faces port congestions, periodic capacity constraints, and lingering bureaucratic delays, especially when it comes to customs clearance and land acquisition for new projects. Energy infrastructure is another critical component. Vietnam historically relied heavily on coal, but the government is now shifting towards LNG, solar, and wind energy to support a more sustainable industrial base. However, as Vietnam's electronics sector now accounts for 40% of total exports, industrial energy demand is rising rapidly. As a result, the country occasionally experiences electricity shortages, particularly during the peak summer months when both households and factories compete for power. These shortages highlight the urgent need for grid expansion, long term energy planning, and more resilient generation capacity. Overall, while Vietnam has made impressive progress in ports, transport, and digital infrastructure, energy reliability and logistic efficiency remain key challenges that will determine how the country handles the next wave of manufacturing growth. Now, let's look at Vietnam's digital infrastructure and supply chain performance, which are becoming increasingly important as country moves towards higher value industries. Vietnam has made strong progress in digital connectivity. The country has nearly 80 million users, meaning 78% of the population is online. 4G coverage is strong nationwide, and Vietnam is currently rolling out 5G, which is critical for smart manufacturing, automation, and Industry 4.0 application. Despite this progress, Vietnam's startup ecosystem is still developing. Investments reached $741 million in 2019, which is impressive, but still far behind Indonesia's $2.3 billion in the same year. This gap shows that while Vietnam has talent and ambition, it still lacks the scale of capital flows needed to compete with larger regional startup hubs. Today, Vietnam has only one tech unicorn, which highlights both the emerging capability and the enormous unrealized potential of country's digital economy. On the logistic and supply chain side, Vietnam performs better than many ASEAN peers, but the overall cost of logistics remain higher than in Thailand and China, which are its main manufacturing competitors. One core issue is that supply chain is still fragmented, with heavy dependence on important components and limited local value addition, especially in electronics and machinery. The rapid growth of Vietnam's electronic industry, which now makes up a large share of total export, has put significant pressure on ports, storage capacity, and freight networks. This is a positive sign of demand, but it also exposes Vietnam's weakness in terms of scale and infrastructure capacity. However, the country is moving in the right direction. Recent administrative reforms have accelerated approvals for industrial zones, logistic projects, and transportation upgrades. These changes are helping Vietnam gradually reduce bottlenecks and improve its position in global supply chains. Overall, Vietnam digital growth combined with gradual supply chain improvements positions the country for its next phase of industrial upgrading, though significant investment and reforms are still needed to unlock its full potential.
Vietnam offers one of the most attractive domestic markets in Southeast Asia with over 102 million consumers and a median age of just 32.5, giving it a young, productive, and increasingly urban population. The middle class is expanding rapidly and is expected to reach 56 million people by 2030, driving strong demand for consumer goods, housing, and modern services. Income levels are rising steadily. GDP per capita is projected to reach USD 4,740 in 2025, and household consumption is growing at 7 to 8% annually. To put this into perspective, per capita household income has climbed from just USD 184 in 1994 to over USD 2,500 today, reflecting significant improvements in purchasing power and living standards. Regionally, Vietnam's strategic location gives it exceptional market access. It shares borders with China, Laos, and Cambodia, and its participation in major trade agreements, including Asian CPTPP and the RCEP, provides companies with tariff free or reduced tariff access to markets such as Japan, South Korea, Australia, and China. This makes Vietnam an ideal base for firms adopting the China Plus One strategy and looking to serve a combined regional market of more than 2.2 billion consumers. When we look at Vietnam from a consumer market angle, the country stands out as one of the most attractive investment destinations in Asia. What makes it especially compelling is how quickly Vietnamese consumers adopt foreign brands and Western consumption trends. This is a market that is open, curious, and extremely responsive to international products. Vietnam's digital readiness strengthens this even further. Internet penetration is close to 79%, and more than 70% of the population uses smartphones. This creates a young, hyper-connected consumer base that engages with brands online, drives trends, and accelerates product adoption. English proficiency is also improving, with Vietnam ranked 64 out of 123 countries. This matters because it reduces friction for foreign companies entering the market, from communication and marketing to customer service and brand education. Most of the consumption growth is youth driven, especially in technology, fashion, brand, beauty lifestyle, and modern F&B. E-commerce is booming, with platforms like Shopee and Tiki dominating the online retail landscape. This makes Vietnam a fast-scaling market where foreign brands can reach millions of customers instantly. We're also seeing a clear shift towards sustainability. Eco-friendly products, greener packaging, and digital payments are becoming mainstream. On top of that, Vietnam's EV sector is taking off, led by VinFast, which is not only expanding across Asia but also entering the US market. This signals rising consumer confidence and growing demand for high-tech, future-ready products. So when you combine a young population, digital acceleration, rising English proficiency, and strong openness to global brands, Vietnam becomes a highly lucrative destination for investors looking for long-term scalable growth. When we evaluate Vietnam from a financial and currency perspective, the country shows a level of stability that is usually strong for an emerging market, and this is one of the key reasons foreign investors continue to choose Vietnam. The Vietnamese dong operates under a managed float system regulated by the State Bank of Vietnam. This means the currency is allowed to adjust global conditions, but the central bank actively prevents sharp volatility. Despite a very strong US dollar environment, the VNE depreciated only around 2.5% in 2024, which is significantly more stable than most regional currencies. This stability is supported by a healthy foreign reserve of over $110 billion, giving Vietnam strong capacity to defend the currency if required. Inflation is also well managed. In 2025, the IMF projects inflation at around 3.4%, keeping Vietnam comfortably within its target band and ensuring predictable operating conditions for businesses. One of the biggest advantages for foreign firms is Vietnam's approach to profit repatriation. There are no restrictions on sending profits, dividend, capital gains, or interest payout out of the country as long as companies comply with tax and documentation requirements under the 2020 investment law. In recent years, the government has further simplified foreign exchange procedures, making life easier for multinationals. On top of this, Vietnam's capital markets are gradually becoming more sophisticated. The government is pushing for an upgrade to emerging market status, which, once achieved, will boost liquidity, attract more institutional investors, and lower financing costs for foreign businesses operating in Vietnam. Overall, Vietnam offers a financially stable, predictable, and investor friendly environment with controlled currency movements, manageable inflation, strong reserves, and clear profit repatriation rules. These factors significantly reduce financial risk and make Vietnam unsafe an attractive destination for long term foreign investment. When considering Vietnam as an investment destination, the financial and capital markets are another key factor that makes the country highly attractive for foreign investors. Vietnam's financial system is predominantly bank dominated, with over 85% of credit flowing through commercial banks. This is complemented by a strong growth trajectory. Bank credit has already risen by 13.37% year to date in 2025, reflecting an expanding economy and active lending environment. Importantly, foreign investors have access to loans, credit lines, and bonds markets under supervision of the State Bank of Vietnam, ensuring both opportunity and regulatory oversight. On the capital market side, the Ho Chi Minh Stock Exchange boasts a market capitalization of approximately USD 250 billion in 2025. The government is actively implementing reforms to attract foreign portfolio investment, including raising foreign ownership limits in certain sectors from 49% to 60%. These changes make it easier for multinational investors to hold significant stakes and participate in Vietnam's growth story. Vietnam's fintech sector is also rapidly evolving, with mobile payment platforms like Momo and ZaloPay facilitating digital finance and consumer transactions. This sector is projected at around USD 17 billion in 2025, highlighting not only innovation but also the readiness of Vietnam's population to adopt modern financial services. In short, Vietnam offers a well capitalized, growing, and increasingly open financial system, combining bank stability, stock market opportunity, and a fast developing fintech ecosystem, all of which significantly reduce financial entry barriers and enhance investor confidence.
Hi everyone, I'm Meng Yao. So now let's move to the investment risk assignment. I will begin with political risk. As the first chart shows, Vietnam's corruption perceptions index score is 40 out of 100, ranking 83rd globally in 2024. This indicates that Vietnam's primary political risks are not instability, but rather issues related to cooperation and governance. Cooperation is largely due to low levels of transparency and media freedom, inadequate systems for holding officials accountable, and poor remuneration for government officials. As for the governance, which is operational friction, especially in areas like the licensing, land use, and customs, inefficiencies can increase the cost and time of doing business. Furthermore, taking Vietnam's performance in global data country risk Q1 2023 as an example, we can also see that Vietnam performs the worst in terms of political risk, which is also the area that requires investors' special attention. Our mitigation strategy is twofold. First, companies must implement robust internal anti-corruption and compliance programs to navigate this environment cleanly. Second, it's crucial to build strong relationships with local authorities to streamline processes. This is a manageable risk with proactive measures. Okay, now let's turn to economic volatility. As an export-oriented economy, Vietnam is highly vulnerable to global economic slowdowns, particularly in key markets like the US and China. The first diagram shows while the US is the dominant export destination, China is the primary source of imports. This creates a dual dependency. A slowdown in US consumer spending directly reduced demand for Vietnamese goods, while economic pressures in China can disrupt supply chains and increase the cost of essential imported components. From a macroeconomic standpoint, this external reliance is the most significant threat to stable recession in one of those major countries would have a direct and immediate impact on Vietnam's GDP growth, manufacturing output, and employment. Therefore, our mitigation strategies must be proactive as well. First, diversify markets. Companies should not only export but also develop customers within Vietnam's domestic and other Asian nations to build a more resilient demand base. Second, it's crucial to create financial models that simulate scenarios like the US or China recession. This ensures the business has contingency plans to maintain operations through the economic downturn. Our third risk category covers finance risk. First, the Vietnamese dong is managed by the state bank and has experienced a gradual depreciation, about 2.5% in 2024. For a foreign investor, this can erode profit margins when repatriation earnings. The mitigation is to use standard financial tools, engage in natural hedging by matching revenue and costs in Vietnamese dong, and use financial hedging like forward contracts to lock in exchange rates. Then let's move to the next one, regulatory risk. The legal framework is evolving and enforcement can be inconsistent across different provinces. This creates uncertainty in compliance for tax, labor, and environmental standards. The critical mitigation step here is non-negotiable. Retain expert local legal counsel. Furthermore, all major contracts should include international arbitration clause to avoid over-reliance on the local court system for disputes. Finally, let's see geopolitical risk. Vietnam's strategic location in the South China Sea is a double-edged sword. As the chart demonstrates, while U.S. imports from Vietnam has grown dramatically, Vietnam's imports from China has also increased. This places Vietnam in the middle of the U.S. China trend and the tech rivalry. Therefore, a strategic mitigation is essential. Supply chain diversification, often called a Vietnam Plus One strategy, ensures investors are not overly reliant on a single geopolitical landscape. Additionally, investors can protect themselves by obtaining political risk insurance from providers like the World Bank's MEGA. Having analyzed these situations and risks, our final recommendation is clear and confident. We strongly recommend a strategic long-term investment in Vietnam, and we especially recommend focusing on sectors where Vietnam holds a competitive advantage and which align with global and governmental trends. The first one is high-tech manufacturing and electronics. building on the existing China Plus One shift. The second one is renewable energy and green infrastructure, supported by Vietnam's PDP-8 and JETP agreements. And the third one is the supporting logistics and industrial park services required by this booming industrial base. To justify this position, let's summarize the most compelling arguments for and against. The case for investment is powerful. Vietnam has microeconomic stability, demographic dividend, reveled market access, and a proven FDI track record. Global giants like Apple and Samsung are already here, validating the investment climate. The case against are primarily operational, like external vulnerabilities and internal frictions. In conclusion, by leveraging Vietnam's strength and strategically mitigating its challenges, the investment can thrive in one of Asia's most dynamic economies, Vietnam. Okay, that's all. Thank you.